The Fed recently announced that it will allow inflation to run above 2% for some periods of time, shifting towards an average inflation target. What does this mean? This means that the Fed is allowing higher inflation. So in today's video, I'll be talking about the Fed's new inflation target, how does the Fed's policy affect inflation, and more importantly, how to beat this inflation. After the Fed announced its latest stance on inflation, this article by Forbes came out with this headline mentioning that the Fed wants to create more inflation. So is it true that the Fed wants to create more inflation? Let's take a look at what the Fed has to say on their official website. This is a page taken from the Fed's official website, and if you take a look here, they mention that when inflation has been running below 2% for a period of time, the Fed will take appropriate monetary policy to push inflation above 2% for some time so as to achieve the target average inflation rate of 2% over time. So yes, it is true, the Fed wants to create more inflation, especially when higher inflation rates are below 2% for a period of time. The Fed is taking a more flexible approach in trying to achieve its inflation target, from having a fixed 2% inflation rate to a more flexible average 2% inflation goal. To give you an example, previously when the Fed still had its fixed 2% inflation goal, even though actual inflation has been below the 2% inflation target, where actual inflation has been 1% for year 1, 2, and 3. In the previous fixed inflation goal, the Fed would still set its inflation target at 2% in year 4. This means that the Fed would use its monetary policy tools to push actual inflation in the economy to 2%. But this was in the previous fixed inflation target goal. However, moving forward, the Fed has shifted its stance on fixed inflation target to a more flexible inflation target. Using the same example as before, let's say that the actual inflation is 1% for year 1, 2, and 3. Under the Fed's new inflation target, its inflation target for year 4 would no longer be 2%. Instead, it would be at 5%. So why is the Fed's inflation target at 5% for year 4 and not 2%? Because as we have seen, the Fed is now moving towards an average inflation target. This means that since inflation has been at 1% for year 1, 2, and 3, in order for the average inflation to be 2% for the 4 years, the Fed has to push actual inflation in the economy to 5% on year 4. This is a simple illustration to explain the differences between the Fed's previous fixed inflation target and the Fed's new average inflation target. The Fed will seek to achieve inflation that averages 2% over time, and when there are periods where inflation has been running consistently below 2%, the Fed will take appropriate monetary policy to achieve inflation moderately above 2% for some time. So this article summarizes the previous example. Now that we have a bit of a better understanding of the Fed's new inflation target, let's take a look at some ways in which the Fed can affect inflation in the economy. One way in which the Fed can affect inflation in the economy is through interest rates. Interest rates and inflation tend to be inversely correlated. What this means is that when interest rates rise, inflation tends to fall. And when interest rates fall, inflation tends to rise. So the Fed, through its monetary policy tools, can increase inflation in the economy by lowering interest rates. Let's take a look at how this works. So first, the Fed will decrease interest rates through its monetary policy tools. And with lower interest rates, more people are able to borrow more money. And when more people are able to borrow more money, there will be an increase in spending. And when there is an increase in spending in the economy, there will be growth in the economy and there will be an increase in inflation. Taking a look at this diagram over here, you can see that there is an inverse relationship between interest rates and inflation. So one way that the Fed can increase inflation in the economy is through lowering interest rates. The second way in which the Fed can affect inflation in the economy is through money supply. And for money supply and inflation tend to be correlated. When the Fed increases money supply in the economy, it can increase inflation. One way in which the Fed can influence the money supply in the economy is through its quantitative easing program, otherwise known as money printing. So by increasing the money supply in the economy, it will also increase the competition for goods and services as there are more money now fighting for the same amount of goods and services. And when there's more money competing for the same amount of goods and services, it typically creates an increase in inflation. So money supply is correlated with inflation. When money supply increases, inflation tends to increase. You can also increase the growth and exposure of this channel by liking this video. And when money supply decreases, inflation also tends to decrease. Those are the two main ways in which the Fed can affect inflation using its monetary policies. Now that you know the Fed's new average inflation target and how the Fed can affect inflation using its monetary policy tools, you can have a rough gauge of how inflation is likely to be in the next couple of years by taking a look at the inflation rates in the past couple of years and what the Fed is currently doing right now. If we take a look at the inflation rates in the years 2010 to 2019, we'll see that in 6 out of 10 years, the inflation rate in the US was below 2%. And in the years 2014 and 2015, the inflation rates were substantially below the 2% inflation target rate. Furthermore, if you take a look at the projected inflation rate for 2020, inflation is projected to be only at 1%. This falls short of the Fed's 2% inflation target rate. And based on the Fed's inflation policy stance, the Fed is likely to want to push inflation even higher. And we can see signs that the Fed wants to push inflation above the current rate through its monetary policies. We see that the Fed is lowering interest rates, and we are also seeing the Fed increasing the money supply in the economy. So higher inflation rate in the future, in my opinion, is inevitable, which leads us to a question of how to beat inflation. The simple answer is this: investing. Obviously, because this is a stock market channel, I'm going to be more biased towards investing in the stock market. But it doesn't necessarily have to be in the stock market. You can choose to invest in real estate, cryptocurrency, and so on. But the truth of the matter is this: you have to invest. Some of you might be thinking right now that investing is risky. And it is true. Investing will always entail some form of risk. But do you know what is more risky than investing? Not investing. The reason is this: if you're not investing and your money is just lying around in a bank account, you are guaranteed to lose the value in your money every year. The interest rates on the typical bank savings account is no more than 0.5%. In fact, many at times, it is even lower than that amount. And if inflation is at 2% each year, what this means is that you are losing 2% of your value of money each and every year. And we know that inflation is going to be an average of 2% each year, because that is what the Fed wants to achieve. And the Fed is one of the most important actors in influencing inflation rates. And this is why it's crucial for you to start investing right now, be it in the stock market or in real estate or so on. You have to invest, because if you are not investing, your money is guaranteed to lose value each and every single year. If investing in individual stocks is risky for you, you could perhaps take a look at investing in the S&P 500 index. Between the years of 1950 to 2009, the S&P 500 produced a real total return of 7%, and these returns have already taken into account inflation. And a quick disclaimer here is that I'm not a financial advisor, so make sure you do your own due diligence before investing. Are there risks in investing in the S&P 500? Sure, there is, as is similar to any other investment vehicles. For example, if you take a look here, during the 1970s, you see that the real total return for the S&P 500 is negative 1.4%. And in the 2000s, you'll see that the real total return for the S&P 500 is similarly below 0%. So in this case, it's negative 3.4%. So there are risks, especially in the shorter and intermediate term. But if you take a look at a bigger picture, such as in the years of 1950 all the way to 2009, you'll see that the real total return over a longer period of time is positive. If you have learned something from this video, make sure you subscribe to my channel, because each week I release one new video about investing, trading, and the stock market. I'll see you in those other videos. To your financial success.